Most people think dividend investing means waiting for the quarterly check, waiting for the monthly deposit, waiting 30 days just to see your money do anything at all. But what if I told you that in 2026, you don't have to wait anymore? You can now get paid every single Friday. Not every month, not every quarter, every Friday, starting with as little as $100. Today, I'm showing you 4 government-backed ETFs that most investors are completely overlooking and how they can turn your portfolio into a literal weekly paycheck machine. Now, before we get into the tickers, here's something important you need to hear first. You might have seen older content talking about weekly dividend ETFs, funds that promised Friday paydays and then quietly shut down because they couldn't survive market shifts. That's exactly why staying current matters. The income landscape moves fast, and if you're following outdated information, you're chasing tickers that don't exist anymore. By the end of this video, you'll have a complete picture of the 4 foundational ETFs that are actually working right now in 2026. The ones built on US government securities, the ones your principal can sleep safely inside, and the ones that keep that Friday ping coming to your phone every single week. Let's get into it. Here's the thing. Most people think dividend investing is simple. You buy something that pays a dividend, you collect the check, you reinvest it, you repeat. And they measure everything in annual yield. Oh, this pays 4% annually. Great, done. But look, that framing completely misses one of the biggest risks in retirement investing. It's called sequence of returns risk. And if you're in your 40s, 50s, or already retired, this might be the most important concept you've never fully understood. Here's what sequence of returns risk actually means. Imagine the market drops 20% in month 1 of your retirement. You still need groceries, you still need to pay rent, so you sell shares at a loss. And now you have fewer shares to recover when the market bounces back. The sequence of those returns, not just the average, can absolutely destroy a retirement portfolio even if the long-term average looks fine on paper. Here's what most people don't realize. Weekly dividend income is one of the most elegant, underrated solutions to this problem. When your capital is paying you every Friday, you are never forced to sell shares to cover living expenses. You are living off the rent your money is generating. The market can do whatever it wants on Wednesday. You already got paid on Friday. Now you might be thinking, okay, but how big of a difference does weekly versus monthly actually make in terms of compounding? I'm glad you asked. Let's run the numbers, because this is where it gets really interesting. Say you've got $100,000 invested at a 4% annual yield. Monthly reinvestment puts your end-of-year balance at roughly $104,074. That's the standard compound monthly math. Fine, nothing exciting. But flip to weekly reinvestment, same $100,000, same 4% yield, end of year, approximately $104,081. Okay, that's $7. You're rolling your eyes at me right now, I can feel it. But here's the thing. Over 20 years, that compounding frequency difference compounds itself. The gap widens every single year. And more importantly, and this is the psychological piece people always miss, when you're getting paid every Friday, you reinvest more consistently. Monthly dividend investors, studies show they're far more likely to spend that payment, delay reinvestment, or get distracted with life. Weekly investors build a habit. Friday comes, money hits, goes back to work. It becomes automatic. Behavioral consistency is worth more than a few basis points, and don't let anyone tell you otherwise. Many people jump straight to the 50% yield funds and lose half their money in a month. We aren't doing that here. These are Tier 1 ETFs, where your principal is essentially protected by the US government. These are the funds that provide the floor for your lifestyle. Let's build that floor. ETF number 1, WKLY. Our first foundational ETF is the Roundhill Weekly T-Bill ETF, ticker symbol WKLY. This is your foundation, your bedrock, your sleep like a baby on a Tuesday night fund. As of early 2026, this fund has solidified itself as the gold standard for weekly cash. Here's what it actually holds: an actively managed ladder of US Treasury bills with maturities between 0 and 3 months. Treasury bills are backed by the full faith and credit of the United States government. They are, by every measure, the safest investment on earth short of stuffing cash under your mattress, and your mattress doesn't pay you 3.5 to 4.1% annually. The expense ratio is 0.19%. That's 19 cents per $100. For every $1,000 you invest, you're paying $1.90 a year for professional management. Roundhill handles all the daily buying, selling, and rolling of these T-bills, so you never have to manage a bond ladder yourself. Basically nothing. Here's a real dollar example. You put $50,000 into WKLY. Every Friday morning, you are looking at approximately $35 to $40 hitting your account. That might not buy you a Ferrari, but it covers a utility bill, a tank of gas, your internet, your streaming subscriptions, covered automatically every Friday without you selling a single share. And you know with 99.9% certainty that money will be there. That's what financial breathing room actually feels like.
Second fund. And I have to be honest, this one is genuinely underappreciated, and I think it's because the name sounds boring. The Texas Capital Government Money Market ETF, ticker MMKT. Hear me out before you skip past this one. MMKT is the first ETF ever designed to comply with SEC Rule 2A7. Those are the strict federal regulations that govern traditional bank money market funds. It holds 99.5% of its assets in cash and U.S. government securities. The 7-day yield is sitting around 4.05% with a 0.20% expense ratio. Think of MMKT as your emergency fund on steroids. Unlike a traditional bank account where you might wait a month for interest, MMKT pays you every Friday. If the S&P 500 drops 10% in a single week, MMKT likely won't move an inch. Here's the analogy that makes this click. MMKT is your high-yield savings account, except it pays you every Friday instead of once a month, and the yield is competitive with the best online banks out there. Now, you might be thinking, why would I put emergency fund money in an ETF? And that's a fair question. Here's the thing, though. MMKT maintains extreme price stability. This is where you park the money you cannot afford to lose. Next month's mortgage, your property tax bill, your car repair fund. It sits there, completely stable, and it pings your phone every Friday anyway. That's a pretty good deal for money that was just sitting in a savings account earning close to nothing. ETF number 3, the TLDDR. Third fund, and this one's brand new as of 2026, the Rex Shares Ladder T-bill ETF, ticker TLDDR. Rex Shares, the same innovative company behind some of the most popular income funds on the market, launched this in January, and it's already turning heads among investors who are paying close attention. Here's what makes TLDDR different from WKLY. Both hold Treasury bills, but TLDDR holds slightly longer maturities, generally under 6 months versus WKLY's 0 to 3 months, and it's actively managed with a specific mandate to optimize around interest rate changes. The projected yield is matching high-end T-bill rates, roughly 3.8% to 4.2%, with an expense ratio of 0.20%. Look, here's why this matters. If the Federal Reserve signals a rate move, either direction, the TLDDR management team can pivot the ladder proactively. A passive T-bill fund just holds what it holds until maturity. An active one can potentially squeeze better yield timing out of the same underlying assets. The smart move? Split your foundational allocation between WKLY and TLDDR. You get 2 different management approaches on the same underlying asset class. If one team makes a better call on rates in a given quarter, you benefit. Diversification doesn't just apply to asset classes, it applies to management strategy too. ETF number 4, TSYW. Fourth fund, and I have to be direct with you here because I see too many people misuse this one. The Roundhill Treasury Bond Weekly Pay ETF, ticker TSYW. This is still a Treasury fund, still government-backed, but, and this is critical, it is 1.2x leveraged. It aims to provide 120% of the weekly return on long-term government bonds. Think of it as TLT with some extra gas in the tank. The yield is around 3.9% to 4.2%, and the expense ratio jumps to 0.99%. That's 5 times more expensive than WKLY. So why would you use it? Because if you believe interest rates are heading down, and a lot of serious economists in 2026 are making exactly that case, long-term bonds increase in price when rates fall. TSYW gives you 120% of that upside, plus a weekly paycheck while you wait for that thesis to play out. Here's what most people don't realize about this fund, though. The leverage cuts both ways. If rates go up, TSYW drops faster than a regular bond fund. This is not your foundation. This is a satellite position. I'd cap exposure here at maybe 10 to 15% of your income portfolio, maximum. Don't let the word Treasury lull you into thinking this is as safe as WKLY or MMKT. It is not. But as a calculated, informed allocation with eyes wide open, it absolutely makes sense. Okay, we need to have a serious talk about the IRS. Weekly dividends are a massive win, but you have to be smart about how you hold them or you'll lose your edge. Here's the bad news first. Because WKLY, MMKT, TLDDR, and TSYW all pay out interest from government debt, that income is classified as ordinary income. It's taxed at your regular income tax rate, which could be as high as 37% depending on your bracket. These are not qualified dividends. Plan accordingly. Comment below, are you a monthly loyalist ready to make the switch, or are you already collecting every Friday? I read every single comment, and your feedback literally shapes what I cover next. If this helped you today, give it a thumbs up and hit subscribe. I'll see you in part 2. Keep investing simplified.